Do you know the problem with keeping all your eggs in one basket? One slip, and they all come crashing down. And the same applies for where you keep your money. But don't worry, Insignis Cash lets you spread your savings across leading banks, maximizing security, flexibility, and returns. No more sleepless nights, no more smashed eggs. So get cash clever with Insignis. Visit insigniscash.com now to learn more and get started today. That URL again is insigniscash.com.
Hey there, FinTech Insiders. We interrupt your usual podcast listening to ask a teeny tiny favour. 11FS is in the running for Consultancy of the Year at the 2025 British Bank Awards, and a 5-star vote from you would absolutely mean the world to us. It has been a busy year at 11FS. Not only have we brought you over 120 episodes of FinTech Insider, our ventures team have also been very busy working with global brands to change the fabric of financial services, whether that's designing new digital wealth propositions to helping credit unions all over the world serve younger people better. And that really is only scratching the surface on the great work that the teams have been doing. If you want to help us out, head to 11fs.com/vote or click the link in the episode description to vote for 11FS and help us bring home that trophy.
Hello and welcome to FinTech Insider. I'm Kate Moody, Customer Strategy Director at 11FS. Today I'm speaking to Philip Bellamont, who is the CEO and co-founder of Zilch. Philip, thanks for joining us in the studio. Great to have you here in our 11FS basement. How are you doing? Welcome to the podcast crew.
No, thank you for having me, Kate. It's brilliant to be here and lovely basement setup you've got, I must say. Looks fantastic.
A lot of soundproofing so no one can hear us scream. Yeah, no, it's all good. Let's start off, I suppose, by giving our listeners a bit of an intro to Zilch, because, again, we have an international base. Some people will know the UK market really well, some people won't. So if they've not come across Zilch, what is Zilch? What do you guys do?
So Zilch is an ad-subsidized payments network, and that, for any normal person, is really, we're a commerce platform. And what we do is we found an interesting way to weave advertising into payments. And so each and every time our customers use our product to spend, we generate ad revenue from wherever it is that you're spending. And we use that revenue to give you the most value each and every time you spend. And that value could be deals, it could be discounts, cashback, or of course, free or subsidized credit. So we're building the most rewarding way to pay. And that is the product we have today in the hands of about 4.5 million customers in the UK. Driving about 3 billion of sales through the platform today.
Not too shabby. And tell us a bit about that core customer. Who is it that you're kind of really trying to reach out to and bring onto the platform?
Yeah, so the way we think about the world of payments and commerce is that this touches everybody's lives. When you think about your day-to-day interaction with the way you pay, you're paying for something every single day. And so the short answer is everybody. We think that there is no good reason why everyone shouldn't be using this product. Why would you not want more value out of each and every time you pay? We think about sort of taking something very ordinary and transforming it into something extraordinary. You know, you just walk around, you tap and pay on the tube, or you go buy coffee or whatever it might be. From that all the way through to larger purchases, something that might be electronics or a holiday we were just talking about earlier. Why wouldn't you want more value from that transaction? And this is something that we think is important, given that over the last 20 or so years, the value for payments for consumers has been completely eroded. And that's largely due to the oligopoly that controls all of the payments in the world today. If you think about it, most countries, payments are controlled by 4 or 5 major banks in each of those countries. And the problem with oligopolies is that they serve themselves. So over time, the value is eroded to you and I, as they collect more of the value. And we're trying to shift that value back to the customer, the consumer, and the brands that you're shopping with.
Okay, awesome. And obviously you've touched on numerous different things you're kind of hoping to help customers with, but ultimately, like, what is that kind of core customer problem that you have at the center of the business? Like when you're kind of talking to your teams, like what is that? I'm biased, right? I'm a customer researcher at heart. Like what is that customer problem that you saw in the market that you really wanted to fix?
Yeah, so if you think about There's a couple of ways to think about the business. So a lot of people think about our business as a consumer credit only type business because we do installment. So the product is you can use our product to spend and pay on debit, or you can use it to pay later. And that is you can pay over 6 weeks or pay over 3 months. And you can do this all within the app. You can change the way the product works in the app. And what we do is we're using ad revenue to make each of those selections. So if you pay on debit, you get cashbacks and rewards. If you pay on credit, you're getting the best cost of credit in the market. And in most cases, you're paying nothing at all for that credit, right? This is the value we bring. That's how the product works. And so a lot of people think of our business as a credit business only. What they're missing is the stack of commerce that we're reinventing. And so, if you liken this to something like, think of NVIDIA at the moment, everyone's talking about NVIDIA, but a lot of people don't understand the company. They think of NVIDIA as a chip business. They create these GPU chips. They seem to look a bit bigger and then a bit bigger each time they show them to us, and people are just buying these chips. That's how a lot of people think of that business. They're missing the point. It's all of the software and integrated stack that reinvents compute that really drives their company. In Zilch, it's similar. So if I talk you through your average sort of shopping as a consumer, and you mentioned consumers and research consumers. So you would be browsing on your phone or on a web page. You would be creating impressions as you're doing that. And in the world of advertising today, what's happening is there is a platform monetizing those impressions. So you're just scrolling through the Daily Mail, or you're on an app, or Apple News. This is creating impressions. And in some cases, you're clicking on things, and that's creating clicks. And people are paying for those impressions and clicks, right? So there's platforms like Google and Meta and DSPs, SSPs, all of these types of platforms. They are monetizing those impressions and clicks. And who's paying for that? Brands are paying for this in the hope that one of these impressions or clicks are going to turn into a sale. But in most cases, it doesn't happen. Mm-hmm. All right. And so what's happening is you're creating all of this. There's this value leakage, right? So brands are paying for your eyeballs. They're paying for you to scroll this page. They're paying for you to click. And then actually you get busy and you come and sit here and we chat and you forget about it. We finish this discussion. You pick back up your phone. You open, again, whatever you were browsing, and actually I like the 10 best boots this winter, whatever that might be, and I click through to go to that web page, and let's just say, it's some a company that sells trainers, shoes, boots, etc. You pay for that click. Someone's now monetized this. You then get through to that site. You haven't bought anything yet, but brands have been paying for all of these impressions and clicks you've generated, and the platform in the middle is taking a cut of that. All right, so you think of all these companies. You then go through and you actually buy the shoes from that brand. That brand has to process that payment. So they're paying the acquirer, the company that helps them collect that payment from you. They're paying that company. That company's sharing some of those proceeds with the bank who issued you your card. You're paying them too. And then, of course, you might take out some credit at the point of sale, these point of sale finance companies, these BNPL companies that sit as a button on the checkout page. Could even be Barclays, these old school banks that used to lend you money to buy the fridge, right? And they being paid, right? In turn, they paying a lender who's giving them the capital to lend. All of these people are value takers. They're taking value from the transaction. And the two most important parties are really you and the seller of the goods to you. These are the two most important parties. And by the way, the two of these parties are paying for all of these companies. All right. Now, that's the stack of commerce. Now, what Zilch aims to do is compress that stack and deliver something that's far more efficient. How do we get brands that are meaningful to you in front of you in a payment product? You're carrying it with you all day. It's in your hand. How do we get that to you in the most effective and efficient and valuable way? You don't want to see a deal that you're not interested in, right? How do we do that? The brand can then pipe their way into a discussion with you immediately, knowing what you can afford. Not paying you for clicks and impressions. You get to the checkout, can't afford it. What's the point? And so they're not paying for clicks and impressions anymore. They're speaking directly to you in a very curated way. You engage with that brand in the same way in return, and you go on to pay with that brand. And Zilch is processing all of this. We've completely reimagined the stack of commerce. And so what that means in monetary terms is that we've reduced the cost of borrowing for the average customer here in the UK by about 55%. This is the marginal cost of borrowing in just 45 months, right? So if you look at the average representative APRs in the UK, we're less than half of that on average. And in most cases, our customers don't actually pay a cent. And that's just in 45 months. On the other side, we've reduced the cost of selling for brands by about 65% over that same period. And that's why this flywheel works so well. And so when people think of us just as, a lender or a BNPL company, they're missing the full stack of commerce we've managed to compress into a new platform that really we think becomes a market maker more than a market taker. A lot of people think about, well, whose lunch are you eating?
Yep.
We just don't think about it that way. We think about if you've reinvented commerce using first principles, and that is, do you want to pay more or less for things? Probably less. Do you want more value each time you pay or less value? Probably more value. Do you want to pay more APR or less APR? Probably less APR. It's just very basic stuff.
Mm-hmm.
And if we've baked that in and gotten that right, we think we can create a whole new market that didn't exist before it. And that's creating a lot of opportunity for companies around us.
Yeah. No, it's fascinating. Absolutely. As you say, I think from the outside, I think there is definitely a tendency to maybe oversimplify the business. And I think one thing that is particularly interesting about your story as a business is, you launched in 2018. Again, if people just think about you as a buy now, pay later business, which as we've talked about, maybe is oversimplifying it, but you weren't the first into this space, right? So how did launching after the likes of Klarna, after the likes of Afterpay, how did that give you sort of a sense of what you needed to do differently to create this different value exchange, to create this different stack? Was that a real benefit for you as a business?
Absolutely. I mean, there's no doubt about it, and I think we've kind of been consistent in saying that it's useful to see what others are doing. And, you certainly benefit from being a younger company. I mean, AI, et cetera, and the use of AI in efficiency is one example of this that, we can talk about. When you've built the business in the world of AI, you benefit from the efficiency from the start. You don't have to fire thousands of staff later because you built it right in the first place. These are some of the advantages you get from being younger. But, the way we saw the market was that people talk about BNPL, buy now, pay later. And we're not even sure what people mean anymore by buy now, pay later. And the reason I say that is, if you think about consumer credit, just generally, isn't it all buy now, pay later? Isn't that the point? You're buying now, whether it's on a credit card or a home loan, or you're paying for it later, right? You're not paying for the house up front and then moving in, right?
Oh gosh, hopefully not, yeah.
Exactly. And so it's all buy now, pay later. So what do people really mean? How does the industry think about this? And the way we sort of looked at the market were in the following ways. So we said, you have traditional consumer credit cards, all right? And if you look at these companies, there's some benefits to these businesses and these products. They're quite easy to use, swipe the card. Maybe too easy to use. They're ubiquitous. You can rely upon them. You can go anywhere typically and you can use them. That's useful, right? And then some of and they're regulated. That's really useful. So if we have a problem, you get all of these protections that you're offered. You can charge back the transaction if you feel you've been duped into paying for something that you didn't get delivered, etc. So that's really useful. The problem is that you have interest rates. So credit cards, the model is very clear. It's hiding in plain sight. I don't know why people try to think about this any differently. The model of credit card companies is simple. Lend the customer enough money that they cannot afford to repay in the free period, the interest-free period. So these cards will tell you have 36 days or 42 days interest-free. They do not want you to repay the money in the 42 days because they don't make any money. So what they do is they try to get that balance right. Let's give you enough capital so you cannot repay it in the 42 days, and this way they can roll you into an interest rate. That is the business model. It's hiding right in front of us. It's in plain sight. Okay, so that's a con. We don't like that. And that is what gets people in trouble, this compounding interest rate. Give you a quick example. At 36.5%, which is the average representative APR in the UK, if you take £500 and put that onto a card here, normal card, it'll take you almost 4 years to repay that capital if you make the minimum repayments, and it'll cost you almost £500 just in interest and fees. All right, so you're swiping 500, you're paying back almost 1,000, right? We don't think that's very valuable. There's a problem with that. So that's traditional credit cards. Then you have these buy now, pay later companies. The companies you mentioned, some of those, Klarna, etc. By the way, some of these really interesting, unique businesses. And there's a whole bunch of these companies are doing really well. We think, there's huge pros to these businesses. For instance, these companies go and they will strike a deal with the merchant and they'll negotiate a commission. So they'll say, you're going to pay us 2 or 3% per sale. And then what these companies do is they use that commission to effectively cover the cost of credit for you if you're taking credit out at that merchant. So they're subsidizing the cost with the revenue they're making from the merchant. That's really interesting. Credit cards don't do that. Credit cards put all of the burden on you. So we loved that when we saw this model. We thought, that's really interesting. On top of that, there's installment payments. So you don't get ahead of your skis. You're paying down the debt as you go. There's no bullet payment in 42 days. You have to make it. Really easy to understand. It's not this revolving interest rate, complex calculation. You swipe £100, it pays down on each installment and you're done. That's really, really good. The negatives of these products are that they're not ubiquitous. They're not everywhere. They're integrated with different merchants in different ways. Different merchants implement those different ways, so it can become quite confusing. Customers can end up with a fragmented landscape of their finance. What I mean by that is you could owe some money with a supplier at Adidas, you could owe some money at Nike, you could owe some money at Boohoo, and so on. That's really confusing. It's difficult to manage that. And unfortunately, these companies largely are unregulated, right? That's a real problem. So life happens. When something happens and you fall behind, how do you have any protection? Can you go to the ombudsman? Can you state that you're in financial distress and create a new payment plan that helps you make your way out of this? If these companies are not regulated, the answer to those questions is that no, you have none of those protections. And that's a real problem. And so, so for us, fundamentally, there's some pros and cons of both. And what we did is we looked at this and said, when we think about credit, how do we take the pros of these products and put them into something new? And that's really what Zilch is. So Zilch is the best of both the credit card model and the installment payment model in that it's simple to understand. We give you a regulated line of credit. You draw down against it in installments. So you're paying it down. That's fantastic. We use it. We generate ad revenue from the merchants, and we use that to offset the cost of credit similarly to those buttons, which is fantastic. It's brilliant. So the cost is the best the customer's ever seen. And at the same time, it's ubiquitous. You can use Zilch anywhere Visa and MasterCard are accepted. And so this means you can depend upon and rely on us. You can use us for everything that you're doing. And so customers tend to use us for discretionary and non-discretionary payment, which is why we see so much share of wallet. And finally, we've baked in a debit product to the business as well. So Zilch offers you debit, credit. It's easy to understand, regulated, and you can use it everywhere. And that, we think, solves some of the cons of these two products over here and gives customers something really valuable. So that's sort of the universe that, we operate in, how we think about the universe of buy now, pay later, or at least consumer credit, and where we sit in that universe. And so, so for us, the whole solution when we looked at the market was, let's build more efficiency and value for customers and go out with something that would be really compelling and over time become more compelling. That's, I think, quite interesting when you think of kind of network effects. A lot of businesses might find a niche and they build something really valuable in that niche. The problem is sometimes the bigger they get, it doesn't drive that compelling proposition further. In some cases, it's the opposite. It might hurt it. And what we've managed to get right here is we have this flywheel of value that gets stronger as we get bigger. And that's quite unique and interesting. And so what I mean by that is for every pound a customer may spend incrementally with our platform, we're able to generate an additional 3% or so of revenue through ads from brands, which leads to customers using the platform more because they get better subsidies and more value. And so customer spend or wallet share goes up by about £50 over that same period of time. And that flywheel and that 50 then gets reinvested back in those brands. And so around and around this goes. And so the way we see the business is that we're building a moat around the relationship we have with each and every customer. Point of sale finance companies are building moats around merchants. Can they win the deal flow at the checkout page of a merchant? And some of them are doing a good job of that. But we just don't see that to be as valuable. We think having relationships with customers, we have 4.5 million customers today. We grow by about 100,000 customers a month. And we think building a moat around that is compelling. If you think about it today, if over the next 3 or 4 years that you're on our platform using our product, pricing has gotten so good for you, and the deal flow from you to the brands you love to shop at has gotten so great and converts at 3 times any other property that brands ever used to try and reach you before, it's very hard to come and disrupt that in the future. And that's why we're excited about what we're building.
Yeah, no, I'm excited just hearing you explain it. So, yeah, and the growth you've experienced has been phenomenal. Again, like for someone who's been under a rock and hasn't seen the progress you guys have made, like again, maybe tell our listeners a bit about the scale of the growth that you've seen, because it's been pretty phenomenal.
Yeah, we've been in the market for about just over 45 months, right? So the business has been around 6 years. We had to build the thing, and test. And of course, we had to go through regulation. So we're a regulated company. We built the business actually with the FCA sandbox here in the UK. And we were excited to celebrate with them their 10-year reunion about that. And it's interesting for a regulator, really forward thinking. I mean, it's quite fantastic to see it. And so, it took us a couple of years to get things built and ready for the market. And we've been in the market 45 months or so. And in that time, we've gone from 0 to 4.5 million customers. Today, we're doing, over 3 billion in commerce through the platform. And what's more interesting is that we've saved customers so far about £600 million in fees and interest and counting. So this is a key KPI for the company. You walk into our offices, it's not about just volume or revenue. Our key KPI is savings for customers and savings for merchants. How much have we saved merchants in selling? It's hundreds of millions of pounds. And so that's the progress. In terms of business and numbers, if we look at revenue, we've grown revenue by about 100+% year over year now for the last 3 years. So we've gone, and this is compounding. So we've gone from 10 or 12 million of revenue 4 years ago to today over 110 million pounds of revenue. And that continues and is accelerating. And so, for us, it's obviously it's been an exciting journey. The question really we keep asking ourselves is it good enough and what's next? How much bigger can we make this business? Particularly given the cost of living constraints we have here. Everyone is feeling inflation, today in the UK, certainly. And I think that's probably true around the world. How are we able to get this product to more people in a shorter period of time as we can to help people put money back in their pockets and at the same time allow brands to make sales more efficiently? Because, we truly believe we'll look back one day and think, if you think about billboards, when targeted dynamic advertising, digital advertising, performance advertising came out through Facebook and these brilliant brands, Google, we all look back and sort of said, billboards are for brand building and radio's for brand building. It's not really performance marketing. And it sort of seemed like a dinosaur for that purpose. We think that's going to happen as well here. If we get this right, and commerce, and we won't be the only ones doing this, and commerce is reimagined this way, I think we'll all look back and go, why were we ever paying for clicks and impressions on these social media platforms? It just doesn't make any sense. This way works much better. So that's the trajectory we are on and why we're excited about the growth we've seen so far. But it's really all about how do we build this business in the future.
I think that's a perfect place for us to pause. And when we come back, we're going to explore that in more detail. Okay, it's all coming up after a super quick break. Don't go anywhere.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alica Bank, who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
Welcome back to FinTech Insider Insights, where I'm talking to the CEO of Zilch, Philip Bellament. Before the break, we discussed in loads of great detail Zilch's story so far and their phenomenally impressive growth. Now we'll look at its plans for the future, and forgive our bias here, but as we're based in London, we do want to discuss London's place as a fintech hub and what it needs to do to keep its place as a sort of challenging place to set up a business. So, Philip, before the break, you alluded to the future trajectory of Zilch. I suppose a key part of that is potentially IPOing, taking kind of this great business you've built and taking it public. Is that still on the radar? Or is that still kind of part of the trajectory that you guys are working to?
Absolutely. So the short answer is yes. We've always said, and we continue to say, we think this business does really well listed. There's a couple of reasons for that. It's a complex business, different types of capital required for a company like this. Public markets affords the opportunity to fund the business in a different way and get maximum return on equity. So we think that's a good starting point. But secondly, wouldn't it be fantastic for customers to be able to own some of this company and participate in the upside of the business? And obviously being public allows for that. So we think that, we can build a significant business in the public eye. We've been quite consistent with that. But when we think about kind of the future of the business, I was listening to something the other day. I think they were saying the future is unknown and unknowable. So I think it's something like that. And that is very much how we behave, I think, with our business. So to answer your question in two ways, I'll talk a bit about the future of the company and then also the listing. So on the company side, we don't know what things are going to look like in the future, right? So for the first time, at least in my life, I find it fascinating that you could genuinely say today, in 10 years, Google may not exist. Okay. I don't think we would have ever said that before, right? But Google search may not exist in 10 years' time, maybe sooner than that. And I think the problem that at least we see with a company like Google, and specifically, Google search, is that it used to be based on first principles, and those are gone. So we like to think about building for the future, not by worrying about what the future may look like, but rather by focusing specifically on the present and building for first principles. We think that if we do that well, we'll win. And coming back to the Google example, I remember when you had AOL, Yahoo, and I didn't even know where the search box was on the page, right? Because they were showing me newspaper clippings here, and it was the weather and the news and the thing and the stocks, and they were going to be, this portal to the internet. And it didn't work. And Google did something really unique. They had nothing on the homepage, on the search page, nothing at all. And it worked great for them. And they actually said, we're going to give you the best search result as fast as we can, even if we have to get it from AOL and Yahoo. Isn't that amazing? And that's why it went so well, worked so well for us. But that's changed. So if you look at it now, the page may still be clean, but you just don't get the best result. And you certainly don't get it fast. I think it takes the average person 3 to 4 searches just to get the answer, right, that you were looking for, because you got all the sponsors on top, whoever's paying the highest bidder is getting your attention. It's very inorganic. And that first principle has been eroded. So why wouldn't you go and use Perplexity or ChatGPT and just ask it? Because it'll wade through now the inefficiency of these models. It'll go and open all the tabs you would have otherwise done yourself. It'll do the search numerous times, and it'll present back to you the actual answer. So who's going to win? And, and that's the way we think about it. So with our business, when we think about the future of the company, we think about it from first principles. It's quite a basic way of thinking. But it's the best we can do. And that is, do you want to pay more interest or less? Less. Do you want more value each time you pay? Yes, these are very simple things. Do brands want to pay more for clicks and impressions that don't convert or go to click farms and impression farms? No, they don't want to do that. So it's very basic, but we think that if we do these core things right, we'll win. And I'll give you one example of just the progress. So I made that example earlier about a credit card. If you pay £500 on a credit card, minimum repayments take you about 4 years. The cost of that in interest and fees is 32 times what it would cost you to make that same transaction on Zilch. So we've improved the marginal cost of borrowing for customers by 32x. We've only been around for 45 months. So imagine how that will look in the future.
Well, that was going to be my question. Yeah, how far do you think it can go?
Well, we hope that one day, largely, we can completely eliminate the high cost of consumer credit. We really think that that's possible. If you look at the trajectory of advertising budgets, and then you overlay that with the trajectory of borrowing as a total amount of money, you really only need to be making somewhere between 4 and 6% of your lending volume to really make a really healthy margin. We make about a 52% gross profit margin. We make an average take rate of about 6%. Very healthy business. So that could be even a little thinner and you would be doing well. And really what I'm saying is if you take the total ad budgets and you divide that into total borrowing, it's more than 6%. So there's the answer, right? This is possible. So that's how we just think about the trajectory and the future of the company. And then when we think about listing and exchanges, again, it's a first principles thing. This is it's a simple problem to identify or a principle. It's maybe very hard to fix. But when you think of the UK, when you think of other exchanges, New York and so on, there's really a couple of things that have to happen. People need to be trading. There needs to be liquidity on these exchanges. Otherwise, there's no speculation. There's no market making. There's a lot of funds that are prohibited from buying stocks that don't trade well because you need to be able to trade in and out of a position in a certain period of time. And so if you really want to do well as a public business, you have to find a market that will allow all of these things. A market that's going to understand the story, provide liquidity, and get the stakeholders of that country also supporting the growth that we want to see. So we were fortunate enough to attend the investment summit and, this massive sign growth, in the reception, which was brilliant. But then post that summit, we've seen a bunch of policy in the budget come out here in the UK. And some of those policies you would argue don't necessarily fall in line with that growth agenda. So how do we think about that? Now, we're always optimistic about the situation, especially here building a business in the UK. It was born here in the UK. Our customers are here today. So we're optimistic about that, but it's something we need to think about, and it's a challenge. How we think about NI, capital gains tax. Are we boiling the frog? Is it going to get worse? We're not sure. We need to see how that all works. And then, of course, you have stakeholders around all of this. So if we're talking the LSE, London Stock Exchange, again, we've got great dialogue with everyone at the stock exchange, and there's lots going on. There's a lot of positive action. So Pisces, this new platform for sort of pre-IPO companies on secondaries, really interesting, again, world-leading and unique. But when you look at the market, how good is the liquidity? So 10 years ago, if you think about it, we've dropped almost 95% in capital raised since 10 years ago to today on the LSE. That's the situation. Now, how does that compare with other markets, etc.? The thing is, clearly, it's not the trajectory we want to see. That needs to turn around. And everywhere is struggling, right? The world is in a strange place. But does it turn around and do we see liquidity? And more specifically, are all of the stakeholders here in this country supporting companies to go and list and stay and build their businesses in the UK? Are pension funds investing in UK stocks? 15 years ago, almost 50% of pension fund money was in British stocks. Today, it's less than 4%, right? Why? There must be some adverse policies driving this problem. And what we really need is to remove all of the excuses from every stakeholder, including the businesses. So, what we love is to be in a position, we say this to every one of our team, put yourself in a position where you can blame nobody but yourself. It's a really good spot to be in. because this way it focuses the mind. I either achieve the outcome or I do not.
Yeah.
Simple, right?
It's a good philosophy.
And we like that because then you have no one to blame, right? You do it or you don't. And you'll find that most people work even harder to make sure they do. And this is what we want to see in the UK, is put every stakeholder in that position. Tell the companies like Zilch, you say you're going to print the numbers, go print them. All right? And leave that to us. That's our problem. We'll put ourselves in that position. But tell all of the stakeholders that they have to lean in and support. Remove the stamp duty for the average person here in the UK to buy and hold a British stock. Why do we have this? You can buy, a Tesla share for free, and you're going to pay stamp duty on a Rolls-Royce share. So which one are you going to buy? And then there's no liquidity in the Rolls-Royce share, so there's no speculation. So what's your return going to be? Plus you have to pay stamp duty. It just doesn't, again, it's a first principles thing. It just doesn't make any sense. So we need to fix all of that stuff for the UK to really thrive. And there's, as you put it, we're the third largest technology sector on the planet here in the UK. We raised more capital in the last year in fintech than all of fintech across Europe. I mean, every country in Europe combined didn't raise the same total value that we raised here in the UK. So we're in a really good spot, and there's a huge amount of innovation. We have a very sophisticated customer here in the UK. It's quite incredible, right? If you go back to the Olympics and the introduction of Tap and Pay NFC, I think the UK has been on the forefront of payment, and you're seeing that adoption of technology just be so rapid. It's actually quite brilliant to see. So you've got this market that's actually saying we want technology and we consume technology and innovation. You've got some fantastic businesses, and we were pleased to chair and to co-found with Innovate Finance, something called the Unicorn Council, which is a collection of about 30 fintech companies, almost 100 billion in private market cap now, companies. So you have some really innovative businesses building innovation. The question is, where does it lead? And, so coming to the answer, it's just really difficult for us to tell today. Where would the destination of listing be, given all of these things going on? And then you throw on top of that, there's been an election just recently now in the US. Of course, we have a new government here in the UK. There's a lot going on in the world. And our business is growing by 100% every year. So if we're thinking about 24 months as a time horizon, how does everything look in 24 months? So what we're not trying to do is preempt that. We're rather sitting and saying, let's just act on first principles, build the business that way. We're offering the same view to, the people we're talking to at the LSE, people like Julia Hoggett, by the way, and doing a great job, and we've been, fantastic to see, but it's a first principles thing. You need the liquidity, you need the stakeholders to lean in and buy and hold these stocks, create the tax rebates that would get all of us buying and holding British stocks, and let's give everyone no excuse to make sure it's the best place to list the company. And why wouldn't people want to do that? And that's the way we're thinking about it.
Yeah, no, that makes an absolute ton of sense. We've obviously spent a lot of our time talking about the success that you've had as a business, understandably so. So one thing I wanted to get your perspective on was your work in the US. Obviously, you put some significant time, effort, investment into exploring that market. You've kind of then decided to pause that. What does that tell us about, I suppose, your overall mindset and approach to kind of international growth? How does that kind of fit into how you're looking at the business as a whole?
Yeah, I mean, so to set some context here, I think the first thing to say is we've got to rewind back to 2020, 2021, like peak ZIRP era, right? And so the capital was the cheapest we've seen in generations. And the whole idea was that you could continue to raise private capital to go and build a business as big as possible, as fast as you could, which was an exciting proposition. And so at the time, we had already created sort of the beachhead of the business here in our home market, the UK. And the aspiration is always and continues to be to build an international company. So that continues to be our aspiration, and we will achieve it. But at the time, you mentioned we've invested quite heavily in this. In fact, that's not true. We didn't really even try. So, what we did is we said, let's a little bit maybe dissimilarly to other companies. We didn't just say, let's go raise hundreds of millions and throw this at the problem. what we did is we said, let's prudently go and test the market. So let's create a finite budget. We will go and create the infrastructure we need and do the partnerships we need to roll out a beta version of the product in the US. And we had some brilliant partners come along for the ride with that. So, we had a federal banking partner. We wanted to launch countrywide. We have 15 state licenses still we hold today in the US. And we launched the business and onboarded about 100,000 customers in the US to test. And so we had a finite testing budget, really. And as we were considering coming out of this test and really saying, now let's invest in the growth of this. We see the product as we found the product market fit we want. Let's look at scaling this. It was exactly at that moment that the market completely melted down. And just an anecdotal story, which is, painful to recall, but, I was with a few of my colleagues and my co-founder, Sean, and we were flying across to Miami to celebrate, the official really launch of the company. And we had the mayor of Miami join us, brilliant, and they were really accommodating. And, the team was excited about this. But on the way over there, the entire market was melting down. I mean, the mood music had completely changed. And so as we landed, we knew we probably needed to cut this ambition on scaling. In fact, this is why I say we didn't even try. We were actually about to start, and we sort of said, we're going to have to pause that ambition. We're not going to roll this out. And so we had to obviously go and do the whole press and the discussion and, talk about the business, and then get back to the office and effectively, as we did, say to the team, we're going to have to reduce the team and we're going to have to pause the rollout. So it was a painful experience, but it was the absolute right thing to do. And this is, I think, the key for us is make the right decision at the right time and don't delay that decision is what we found to work well for us so far, at least in the company. And so what we really did is we had the beta test, we collected a huge amount of data, we found a product that works for us. And exactly at that moment, we said, let's not now ramp up the spend in this market because it would require us raising further capital. And our view was we have to assume there is no more capital ever. That was our assumption, right? That's the assumption we took. And so we said, let's curb that rollout and let's actually it's not about cutting the cost. What we actually did is take that then capital we were going to invest in the rollout and invest it in accelerated rollout in the UK, where we had a more mature, very gross profitable business, paying back customers in 6 to 7 months. And so the faster you can obviously acquire that customer base, the better, because in 6 months' time, the capital comes back. You can do it all over again.
Yeah.
And that was sort of the balance we had to strike, is not necessarily cost cut, it was allocation of capital. This was the challenge. And so that's where we really then sat with the team, fast forward to a year ago, the beginning of last year. So that was 2023. And we sort of said, look, let's just allocate this capital. A lot of companies are trying to cut their way to profit. The problem we believe with cutting your way to profit is that unless you are already of scale, if you cut your way there, you sort of just become moribund, right? It's very hard to then create excitement about your story because you're here now, but really, how do you reaccelerate that? And so we took a decision, which is we have to grow to profit. And so let's cut the money we're spending this side, but reallocate that spend in the UK and grow our way there. And obviously that's quite an uncomfortable strategy because if you get it wrong, you accelerate into the wall. And so we got the whole team together and we said, look, here is the position. This is the exact spot that we keep talking about. If we take this approach, we can blame nobody but ourselves. We have the capital. Investors have supported us. We're fortunate that we have this, right? All of the stakeholders around us are saying, we trust in you all right? And we're coming up with this. Do we all believe we can do it? Let's put ourselves in that spot. And everyone came together and the key stakeholders of the business that lead each area of the company said, we can do it. We can deliver the number. Leave it with us. And so, for me, this was such a great example of this. It turned out well for us. We managed to get there. So, in July, we printed our first month of profit. It was our first quarter now thereafter. And we've printed our record profit now previously here now in October. So thankfully it's worked for us, but that's because everyone put themselves in this uncomfortable position where we could blame really nobody but ourselves. If we got this wrong, there would have been no one we could have looked at. We couldn't blame the macro. We couldn't blame investors. We could have only looked inward and said, we set the strategy and we didn't do it. And so, that's what helped us to really get to where we are. So we've grown into that. And that's really how we've thought about international, whether it be international or new products or new verticals, we think of it the same way. It's an allocation of capital challenge. Do we believe it? Is it the best way for us to spend our capital for an outcome? If it is, do it. If it's not, don't do it. So again, back to sort of a first principles approach. And so we're excited about the US in the future. We're excited about Europe in the future. Again, we talk about this a lot, and we feel that, ultimately, we want Zilch to be a product that sort of defies all of the typical constraints of financial services. So we want Zilch to be as borderless as music, right? If you think about these days, you'll hear something in one country, you'll fly somewhere and jump in a cab in the other country, and it's the same song playing on the radio.
It's always Ed Sheeran.
You're right, exactly. And it's fantastic, though. That's brilliant, right? Financial services kind of don't work that way. And we really want to try and achieve that for our customer. Wouldn't it be fantastic if everywhere you went, you could use the product and get the same types of value, whether that was in one country or another? So needless to say, that strategic move has allowed us, frankly, even to be sitting here having this conversation. Because if we didn't do it, and then we didn't subsequently get it right, well, we wouldn't be sitting here. Or we might be, but we'd be talking about why it went wrong and what lessons we learned and on what not to do. And so, I'm excited that obviously this was a huge milestone for the team. This is like, every single one of the team woke up every morning worrying about this and understanding it's on them. It's on each and every one of us. We must do it. And here we are today. So that's great. And look, we've got a lot ahead of us, but you've got to take one day at a time. And right now we're feeling pretty good about that move. So that's really what's happened there and how we think about the future. We will be back. We will build the business internationally. What we would love is a situation, and that's our trajectory, where we can generate enough free cash as a company to do all of this and not depend upon external capital to help us do that. And then this way, again, we put ourselves in a position where we can blame no one but ourselves.
Yeah. I'm really gutted because I had a ton more questions that I wanted to ask you, but we've hit our time, and that feels like a pretty good spot for us to end. I have absolutely no doubts that you're going to continue to go from strength to strength. So thank you so much for taking the time to join us, for sharing the story of Zilch today. If people want to find out more about you as an individual, about Zilch as a company, where should they look?
So you could just find us at zilch.com. And for me, obviously, just find me, P. Bellamant, on LinkedIn. And our LinkedIn on Zilch is also pretty great. So if you want to learn a bit about the culture, the company, the people, you can go to LinkedIn and check it all out.
Awesome. Thank you so much for listening. If you like what you've heard, follow our podcast and don't forget to leave us a review. It helps us to make it better and helps others to find the show. As always, if you want to join the conversation, find us on social media. Just search for 11FS or FinTech Insider. Maybe not on Google, based on our chat. Or email podcast@11fs.com. Thanks very much. Goodbye.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alika Bank, who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.